The 4% rule is the foundation of so much of what we do as financial advisors, as retirees, to see how much can we actually spend in retirement without running too high a risk of running out of money. But the 4% rule in many ways is outdated. And today I'm talking to the author himself, where he says that the actual rate that you can pull from your portfolio is closer to 4.7% or higher based on a few conditions. That's what we're talking about in today's episode. Today, my guest is Bill Bengen. He is a former aeronautical engineer from MIT. He's a former financial advisor. He is the original author of the 4% Rule white paper, and he is out with new research showing us how you can live a richer retirement if you tweak a few key things with your portfolio and with the way you determine withdrawal rates. Enjoy today's conversation with Bill Bengen. Bill, thank you so much for being on the show. Really appreciate you making the time and excited to learn a lot from you today.
Well, thanks for the invitation. I'm looking forward to it.
One of the things that you're, of course, very well known for is this whole 4% rule. I think some people take for granted as just a rule of thumb that's existed forever, but it hasn't. That was based upon a lot of research that you've done, that you did back in 1994. You have a new book, new research that I'm really excited to talk to you about because it's going to really enhance the way people can think about their retirement and what their retirements can look like. But before we jump in there, I'm curious to hear from you. Prior to this seminal research that you released back in 1994, how are people approaching retirement planning in terms of figuring how much they could pull from their portfolio?
You know, it was an issue that wasn't addressed in the literature at all. I know because I searched for it from magazines and professional journals, and ended up talking to some of my local from the financial planner friends in San Diego area. And most of them admitted they didn't have any sort of scientific basis for they're doing, they just try to get the guesstimate. That wasn't good enough for me or my clients, so I decided I'm going to study it myself.
And what was the point at which you decided to do that? It was after one single conversation, you said, this doesn't exist, I'm going to go do it? Or was there some pivotal moment where you said, I'm going to take on this mountain of research and jump into it?
I saw more and more clients asking me the same questions. How much do I need to save for retirement? How much can I spend in retirement? And it became a roar, a background roar. And I know I didn't have answers, so I was desperate. That's why I decided to go ahead and find out for myself.
Yeah. And I'm grateful you did. I know a lot of great people are grateful you did because that has become a core part of retirement planning today. One thing that I often hear people say is, hey, the 4% rule works. We're going to take that money out, but I'm there might be a market downturn. So I think I'm going to back off a little bit, or I'm concerned about inflation. So I'm going to back off a little bit. And what I don't think they fully appreciate is the context in which you did your research. It wasn't the sense of if everything's good, you can spend 4%. You referenced the Big Dipper, the Little Dipper, these various market events. Do you mind even just giving a background for the context in which this research was done? Because I think that helps put people's minds at ease that if it could work then, it can work now.
Yeah, what I was trying to identify in that first paper back in 1994 was the one retiree who historically had the worst experience of them all. And then whatever withdrawal rate would have worked for him then should work for everyone else because he had the worst experience. And it turned out to be the person who retired in October of 1968, which, as you may recall, this preceded of two major bear markets back to back, which were devastating, and then 10 years of very high inflation, which forced people to increase withdrawals every year at a very high rate. And that was a terrible time. It just devastated portfolios in the 1970s. And I hope we don't see that again anytime soon.
Mm-hmm. And as you're doing that, I think that one thing I just want to add color around for people listening is, we talk about inflation today, and is it higher than it's been? And certainly higher than it's been in a decade or two. But the context that Bill's talking about, inflation was in the double digits for a prolonged period of time.
That's right.
Bear markets were going down. You have this combination of high inflation and deflating asset prices. Not a good situation. Yet that 4% rule was your way of saying, if you're not exceeding this initial withdrawal rate from your portfolio, even in that period of time, given a fixed duration of retirement, assets could last for that time period.
Yeah, it's a worst case situation. People need to resign themselves that. And we haven't seen a repeat of those circumstances since then. So naturally, if today I'd be recommending higher withdrawal rates than that to anybody retiring today.
Yeah. And I want to jump into that in 1 second, because I think the good news, just a teaser for everyone, and the book's in the background. And by the way, get the book, A Richer Retirement. Bill, we're going to talk about more of that in a second here, where the good news is a lot of people can spend more than 4%. But before we go there, did anything surprise you about that initial research you did on the 4% rule, or did it confirm what you already felt to maybe be true?
No, always were surprised. I think the first big surprise I had when I was trying to test how your safe withdrawal rate varied with the asset allocation of portfolio. I thought it'd be a curve starting in the lower left and going up. The more stocks, the better. Turns out it's more like a mesa. It looks more like a mesa where there's a flat spot in the middle between like 45 and 75% stocks, where you essentially get the same withdrawal rate no matter which allocation you choose. But if you go too much in stocks or too little in stocks, your withdrawal rate drops off.
Mm-hmm. Interesting. So in other words, too aggressive or too conservative, you can't make the case. You can't just assume that this 4% rule is going to magically materialize regardless of how your investments are positioned.
You need to have a significant portion of your investments in growth investment stocks and the like.
Mm-hmm. And so with that as the foundation, what was the ideal allocation from just stocks to bonds allocation for someone that did want to spend 4% throughout retirement?
In that first paper, I was working with just two asset classes, intermediate term U.S. government bonds and large company U.S. stocks. And as it turned out, for those particular two asset classes, they combined to produce, this particular withdrawal rate.
And with that withdrawal rate, what's changed? Because if I'm remembering correctly in your initial white paper, the 4% rule, in your words, is that's kind of worst case scenario. If you are the unluckiest retiree and you retire right in a period of high inflation, down markets, bear markets, 4% is the most. But if you take a random year like 1975, I think it was about 7.5% that retiree could have spent. And when you quantify that, that's not just, oh, cool, you could have spent more. That's if you have $1 million in your portfolio, you could have spent an additional $35,000 per year throughout your retirement. How much more meaningful would your retirement be? How much richer would your retirement be if you did that? What does your new research show as you kind of saw that and amplified it?
Okay. What I've done as I've made my research more sophisticated, I've increased the number of assets. So now I'm up to 7 from the original 2 in the portfolio. I'm including U.S. micro cap stocks, U.S. small cap stocks, international stocks, and also treasury bills. And that bumps the worst case number up to 4.7%. But we have to keep in mind that historically, over the last 100 years, the average for all retirees has been 7%, slightly over that. So getting 4.7, pretty meager compared to that.
Mm-hmm. And so was it that alone? Was it purely the fact that you've diversified the asset classes that led the 4% to turning into the 4.7, or were there other factors on top of that?
No, it was primarily the addition of asset classes and the greater diversification.
And what was the reason, even going back to 1994, was the reason for choosing just those two asset classes just that there wasn't a long enough track record of these other asset classes to use them? Or was it just start, I won't say simple, because there's a lot of research that went into it, but what was the reason for that?
I want to keep things simple to start. I took two assets which I thought would probably be in everyone's portfolios, and which had good returns for their respective types, and use them as a proxy for a diversified portfolio. But we know, when you increase the number of assets and diversify, you increase your returns. That's been established for a long time.
Mm-hmm. And so what's different about this new research versus, for example, going back to the initial white paper, just two asset classes, even subsequent to that, you introduced a small cap allocation to the research, and you saw that could increase the returns. What's now different about your new book, your new research that investors should know?
Sure. I had started with a 4% rule, but I also explained in some of my papers that many investors, retirees, are able to access much higher withdrawal rates, 5, 6, 7, even up to 15%, depending upon the circumstances when they're retired. So that I was looking for a way to be able to scientifically connect market circumstances with those higher withdrawal rates, so we could have a basis for saying, no, don't take 4.7, you should take 6.2 now, or something like that. And about 4 years ago, I had a breakthrough. I learned that putting inflation first ahead of big stock market declines and organizing the data in that structure developed patterns which I could use then to, if you will, so-called forecast and predict what your safe withdrawal rate should be.
Hmm. And what do you mean by that? Do you mean, like, for example, if I look at inflation today, that should be the thing I start with when deciding how much I can or a client can withdraw from their portfolio, or monitoring inflation throughout retirement?
Yeah, I think there are two factors. One is inflation. You want to develop an estimate of what inflation will be like the first 10 years of your retirement, which can be very difficult, admittedly. Ideally, if you could just pick a number for all of retirement. And the other one is stock market valuation is very important. When stock markets are expensive, we're probably close to a major bear market, and major bear markets early in retirement can devastate your portfolio. So if you have cheap stocks and you have low inflation, you're in nirvana. If you have the opposite, you're in trouble.
Mm-hmm. And so that much wider range, the 4.7 to, I think, what did you say, 7%? That's based upon a mix of what is inflation today and valuations of equities as a
Yeah.
whole.
Yeah. I mean, the person retired, if you remember, at the end of the great financial crisis in April of 2009, I calculate they'll probably be successful with an 8% withdrawal rate. And that's the highest withdrawal rate we've had in the last 30 years because stock markets have been so expensive. For a few months, stocks actually got cheap, which was a wonderful feeling, but not today.
And even if we look at that time, so an 8%, that would be from the bottom of the Great Recession on. Is that what you're saying?
Right.
Got it. So which seems to align with the research well of prior to that downturn.
Mm-hmm.
That same dollar amount of withdrawal probably would have represented somewhere in the 4.5% to 5% range of the prior portfolio value that simply took a big beating. Is that fair to say?
I don't know if I characterize it that way. It's just that clearly things had changed in my perception of what was important in the problem, and having a way to. That was a great moment for me when I was able to develop that tool because that was the missing link. I really had nothing to tell people in terms of choosing a high withdrawal rate, except give them a chart saying, if you take this rate, 50% of investors have been successful, otherwise 75%. And that's really no way to run a railroad. Clients deserve more certainty than that.
Yeah. One more question on that, and then I want to shift the focus a little bit just to even application for a lot of people. And where does, I don't want to call it theory because it's very real. It's very real research, but where does that meet how people actually draw money from their portfolio throughout retirement? Just out of curiosity, what drives your continued research? Is it simply playing with the numbers, playing with the modeling, or is it conversations you're having, things you're seeing? Like what are the things that lead to those breakthroughs that you have?
It's a combination of things. I get a lot of folks write me and with good ideas, and I'm developing a very long research list. There's just a lot of areas that I want to explore more thoroughly to understand. One of the most important, I think, right now is, I'll be using a 55-45 or 60-40 portfolio. Is that the best? Early indications are that a higher stock allocation would benefit most investors, particularly those who retired near the beginning of a bull market. And they could get significantly higher withdrawal rates than the ones I've been using. So I'm going to spend a lot of time in that and see if I can upgrade the withdrawal rates scenario.
What's the biggest mystery that's yet to be solved when it comes to this topic? What's the next big challenge you're going to try to?
That's a good question. I would like to understand a little bit more about that rising equity guide path system, which basically assumes you're going to have a lower allocation equities at the beginning of retirement. You actually increase it during retirement. When I tested it against all my retirees, they all had a bump to their withdrawal rate, upward bump, some more than others. Don't fully understand why that works, and I would like to explore that in a lot of different scenarios to really appreciate how that can benefit people.
Love it. Where your research and the work you've done meets practical application, because your history is as a financial advisor. You are, of course, and what I would consider a much more even you were an aeronautical engineer prior to founding your own financial advisory firm. So the rigor and the level of detail that you approach things with, I would say, is very unique. But where do you find the research? Are there challenges or are there constraints where that meets practical application for a real life retiree?
Well, I try to emphasize developing means that are readily accessible and usable by the individual, and that aren't too mathematically complicated. I don't think really complex mathematics fits our current state of our profession. We just don't have any underlying theories for economics or for finance, like physics has, laws of motion. We don't have those. So everything we do is empirical. We have to look at test results, what's happened in the markets over time, and then try to analyze what patterns are there, and then try to use those to extrapolate into the future.
Mm-hmm. So if I look at a couple specific examples, someone that retires at 62, but Social Security doesn't start until age 70. There's this dynamic of you're going to withdraw more than 4% up front or 5% up front, but maybe far less on the back end, or even research around retirement spending as a whole that doesn't necessarily increase in lockstep with inflation. But people tend to spend less over retirement, maybe until latter years of their life where medical expenses really increase their overall costs. Is there a way, or is it even necessary to try to marry that research and that reality with, I don't want to say a fixed withdrawal rate, but starting with a 4% or a 5%? Or is that just what financial planning is all about? Of how do you take various pieces of empirical evidence or research and say, combine these in a way that works for the investor?
Yeah, I think the latter would be the approach I'd recommend. Every client is different. Their needs are different, and their other source of income vary. So that you have to treat each case separately and develop a plan based on what you see before you.
Mm-hmm. Mm-hmm. Are there any pieces that people commonly get wrong about your research, or application that people commonly get wrong? Because I've seen it talked about in many different ways, and sometimes it feels like people are inventing their own aspects of what you've done. But do you see people getting it wrong? And if so, where?
Less so than before, but one of the biggest things over the years I've had is people hear 4% rule, and they think take 4% of your portfolio value every year. That's not how that system works. It's more like a cost of living adjustment, Social Security kind of system, where the first year you apply the percentage, and then after that you throw the percentage away and just give yourself a cost of living adjustment like Social Security.
Yeah. So it's not a fixed percentage. That percentage is going to fluctuate. Could go up or down, kind of inverse relationship to the value of your portfolio. What's the withdrawal rate actually doing? But not just.
You mentioned also there are other ways to withdraw money. One is to take more earlier and less later. That's a perfectly valid way, and I analyze that in my book. You can look at a fixed percentage if you want, which is normally the misconception of what the 4% rule works. But if you actually apply that rule, you come out with some interesting results. And also, how much can you handle in a big bear market? If your portfolio drops 35%, and your withdrawal rate drops, can you handle that in the context of your lifestyle? Mm-hmm. So it's got some uses, but it's got some warnings as well.
Yeah. I don't want you to give away the contents of your book. I know we talked about it a little bit. I'm encouraging people, go purchase A Richer Retirement. I think a lot of great research there. But what are you most excited for people to learn or understand about your book that they can use to create a richer retirement?
Sure. I think what I like people to come away from my book is that planning for your retirement withdrawals is a process, that the first step is not to find a number. That's actually the last step. You have to identify all the personal factors, or elements, I call them, that make you unique and your retirement plan unique. You have to evaluate where inflation is and where market valuation is, and then you come up with your number, finally. But it's a process and not a one-step go.
Love it. Where can people purchase your book, Bill?
Any major online bookseller should have that, is offering right now. Amazon, Barnes & Noble, Books A Million, Powell's. It's all available through them.
Love it. I will include a link to that book directly in the show notes for this YouTube, this podcast, this video. Any final thoughts, though, Bill? Anything that you want to leave people with that you wish they understood differently about calling it the 4% rule? Now, I'm not going to call it that because it's different, but any final words or things that you'd want to leave people with?
Yeah, when folks buy my book, I like to pay particular attention to that chapter to the end when I talk about how to manage a plan during retirement, because that previously hadn't received much attention in the literature. And I identified a couple of circumstances where your plan may deviate from the benchmark and what you should do about it. In summary, if it's a stock market decline, you probably don't have to do anything. But if inflation rears its ugly head again, you need to get worried and start taking measures immediately to protect your portfolio.
Well, I think that's a great thing to end on, because I think that it's always good to have a plan going into retirement. It's always good to have a general framework for what that's going to look like. But if there's not adjustments being made along the way in response to the right things, and in this case, the right thing might be inflation, less so other aspects, right, you're either leaving money on the table or potentially setting yourself up for a less than ideal retirement, both of which are not ideal. So, Bill, thank you very much. Thank you for the work that you've done over the past 30 plus years for the retirement community, for the financial advisor community. I know that a lot of people are better off because of it. So thank you for spending a few minutes with me and with us here on this channel.
Thanks for the invitation. I enjoyed it.